Imagine creating a therapy that nearly doubles the survival time for one of the most aggressive, deadly forms of brain cancer known to humanity.
Right. I mean, you have the clinical data. You actually have the science.
Exactly. Now, imagine being so close to absolute bankruptcy that your auditors are formally warning the public that you might not even survive the year.
It is the ultimate paradox of the biotech industry, really. You can hold the key to a medical revolution in one hand and, well, be checking the couch cushions for your next month of rent in the other.
Welcome to today's deep dive. We are unpacking the incredibly high-stakes reality of Northwest Biotherapeutics today.
Yeah, and we are looking at a pre-commercialization biotech company sitting on what could be a groundbreaking cancer therapy.
But, and this is a massive but, their stock is just languishing near its 52-week lows.
Right, and they are staring down a regulatory decision that is essentially going to make or break their entire future.
So whether you are looking for those extreme asymmetrical risk-reward setups or you're just, fascinated by the brutal economics of medical breakthroughs, you're going to want to hear this.
We really need to start with the underlying asset here, though. Before looking at the terrifying state of their balance sheet, the science actually demands our attention.
Yeah, let's get into the sources on that.
So we are talking about a proprietary platform technology called DCVax, and specifically a therapy known as DCVax-L. This targets glioblastoma, or GBM.
Which is notorious. I mean, glioblastoma is an incredibly aggressive brain cancer.
It really is.
It's one of those devastating diagnoses where the medical community has just been desperately hunting for a true breakthrough for decades, mostly because the traditional tools like surgery, radiation, standard chemo, they often just bounce off it.
Or they only buy a very limited amount of time. The standard of care has barely moved in years.
Right.
And that massive unmet medical need is the backdrop for what Northwest Biotherapeutics managed to pull off. They completed a 331-patient international phase 3 trial.
Which, just getting a therapy through phase 3 is already a statistical anomaly in biotech.
Exactly. But the data they published is what truly turned heads. We are looking at a personalized dendritic cell immunotherapy.
Okay, let's pause right there and actually explain that mechanism. Because personalized dendritic cell immunotherapy sounds like something out of a science fiction novel.
It does, yeah.
For anyone listening who isn't an immunologist, think of dendritic cells as the high-level intelligence officers of your immune system.
That's a great way to look at it.
They don't necessarily do the fighting themselves. Instead, they gather intelligence. They find the specific cancer antigens, pick them up, and then present that information to the T cells.
Right, and the T cells are the actual foot soldiers.
Exactly. The dendritic cells give the T cells the exact coordinates and a description of the enemy.
That is a perfect way to visualize it. So Northwest is taking a patient's own immune cells, essentially pulling those intelligence officers out of the body and training them in a lab. Yeah, they expose those dendritic cells to the biomarkers from that specific patient's tumor. Then they put those highly trained cells back into the patient, where they can marshal a highly targeted immune response against the glioblastoma.
And because every single human being's tumor is unique, the therapy has to be unique.
Exactly.
You are custom building a biological weapon for one specific person at a time. So how did this bespoke weapon perform in the actual trials?
The trial demonstrated a statistically significant and clinically meaningful extension of median survival. For newly diagnosed patients, the therapy extended median survival to 19.3 months.
Okay.
And the historical average for those patients is 16.5 months.
So almost 3 extra months for a newly diagnosed patient, which is a very big deal in the world of glioblastoma.
It is.
But I was looking at the data for the recurrent patients, the people whose cancer had unfortunately returned, and man, that data stopped me in my tracks.
The recurrent data is definitely the standout here. For those patients, the median survival was extended to 13.2 months.
And the benchmark?
The historical benchmark there is a mere 7.8 months.
Wait, hold on. I need to stop you there. They took the historical survival time for recurrent brain cancer, and they nearly doubled it.
Yep, they nearly doubled it.
That borders on a miracle drug for those families.
So we have a therapy that is clearly demonstrating profound clinical success.
Yes, but, and this is a big but, this is where the story shifts from a medical triumph to an absolute operational nightmare.
Right. Because they didn't just invent this therapy, they decided they needed to own the entire process of making it.
Yeah, they chose the path of aggressive vertical integration, which is exceptionally rare for a company of this size.
To say the least.
Rather than outsourcing the production of DC Vaxxel to a massive third-party manufacturer, they recently acquired a company called Advent Bioservices for 1.4 million British pounds.
Okay.
And that acquisition allowed them to bring all the manufacturing in-house to a facility in Sawston in the UK. And they aren't just, occupying the building. The sources show they are actively building out new grade C clean room capacity to roughly triple their current output at that facility.
Right.
But maintaining that kind of bespoke manufacturing isn't cheap. It's like building a state-of-the-art Formula One factory. You're keeping hundreds of elite, specialized engineers on the payroll, maintaining a sterile environment 24/7, turning the lights on every single day.
But you haven't actually been cleared to sell a single car yet.
Exactly. Does bringing manufacturing in-house actually create a competitive moat for a pre-commercial company? Or is it just an incredibly expensive distraction?
Well, the capital intensity is just staggering. Personalized cell therapy manufacturing cannot be scaled like traditional pharmaceuticals.
Right. You aren't just mixing massive vats of chemicals and pressing out a million identical pills.
No, it is an artisanal batch of one process. You have to harvest the cells, transport them securely under strict temperature controls, process them in a sterile grade C clean room, and get them back to the clinic.
Which fundamentally explains the financial tightrope they're walking. Owning that F1 factory without selling any cars is draining their cash so fast that it threatens the company's very existence.
It really does.
Let's look at the math, because the financial dashboard here is flashing red. For the fiscal year 2025, Northwest Biotherapeutics reported total revenue of just $1.4 million US.
And that revenue figure matched their prior year. It even beat analyst estimates of 1.0 million, which is something.
Sure.
However, because they are pre-commercialization, that revenue comes from very limited, specific manufacturing activities, not the broad sale of an approved drug.
And those limited activities create one of the most bizarre accounting paradoxes I have ever seen. On a trailing 12-month basis, the company boasts a 100% gross margin.
Yeah.
If you just glance at that, you might think they have the greatest business model on earth, but then you look one line down at their net margin, and it is a staggering negative 2,931.73%.
It's wild. That paradox tells the whole story of their vertical integration.
Right.
The 100% gross margin is essentially just an accounting quirk based on the pure manufacturing nature of their tiny, limited revenues. But that negative 2,931% net margin.
Yeah.
That is the crushing weight of the unyielding fixed costs required to keep the Sawston facility open, staffed, and ready for regulatory inspections, all without a commercial product to actually offset those costs.
It is the brutal reality of their operating expenses. For FY 2025, their earnings before interest and taxes, their EBIT, came in at a negative $59.9 million.
Wow.
They lost nearly $60 million just keeping the machine running.
They are showing some signs of tightening their belts, though. Moving into the first quarter of 2026, their operating loss narrowed to $10.9 million, down from $17.3 million during the same period the previous year.
Okay, so they're trimming some fat.
Yeah, they've been cutting research and development expenses to survive. But we have to address the elephant in the room. How does a company losing tens of millions of dollars a year actually stay alive when they only bring in $1.4 million?
They operate on what the industry calls a raise-as-you-go financing model.
Yeah.
To put it plainly, they are surviving by constantly selling off pieces of their own company to whoever will buy them.
It is the ultimate manifestation of the biotech valley of death.
The valley of death.
Yeah, that term describes the agonizing gap between a successful clinical trial and actual commercialization. You have the brilliant science, but getting the regulators to approve it and building the factory to make it requires a mountain of capital.
And Northwest is attempting to cross that valley on a shoestring budget.
A very, very thin shoestring.
Just look at how fast that shoestring is burning. They ended 2025 with $3.0 million in cash.
Right.
Just 3 months later, by March 31st, 2026, they had burned through a $12.5 million cash outflow and were down to a mere $1.8 million in the bank.
Man.
I mean, how can a company with a potentially life-saving drug be down to its last $1.8 million? We're talking about a company that holds the patent to a therapy that significantly extends life for brain cancer patients, and they are literally scrounging in the couch cushions.
Because the financial markets do not fund past clinical success. They only fund future cash flows.
Ah, that makes sense.
And right now, the future cash flow of Northwest Biotherapeutics is entirely dependent on regulatory approval.
Mm-hmm.
Until that approval happens, the market views them as a massive liability.
Right.
The only way to pay the bills is to issue new shares, which brings us to the true cost of this strategy: shareholder dilution. Does the brutal reality of that dilution completely overshadow the clinical success of the drug?
For the people who believed in this company early on, the cost is agonizing. The sources show that in 2025 alone, the company had to issue approximately 96.7 million new shares.
Ouch.
And they didn't even issue those shares to build a new research lab. They issued them just to settle roughly $19.7 million in existing debt and accrued interest.
Yeah, when a company floods the market with 96 million new shares, every single existing share suddenly represents a much smaller fraction of the total company. It is a necessary survival tactic, but it aggressively punishes the retail investors and early believers who have been holding the stock.
The situation is so dire that the company's own auditors issued a going concern opinion on their December 2025 financial statements.
Which is a huge deal.
Yeah, for anyone listening who is unfamiliar, that is an auditor officially waving a massive red flag. They are telling the public that there is substantial doubt this company has the resources to even keep its doors open for another 12 months.
Which puts the entire investment thesis into a vice grip. For the company itself, every single cent they raise through this painful dilution is being funneled directly into the engine room.
Into the F1 factory.
Exactly.
Yeah.
Scaling the Sawston manufacturing facility and prepping the paperwork for a potential commercial launch. But for a short-term investor, it's a nightmare. You're just watching your equity evaporate month after month while the company tries to stay afloat.
Because their cash runway is virtually non-existent, the entire company is now sprinting toward one singular value-defining event. It is a binary catalyst that could either instantly validate all of this financial pain or turn the lights off for good.
We're talking about the regulatory review currently underway in the United Kingdom. Northwest has submitted a marketing authorization application, or MAA, to the MHRA.
Which is the UK's equivalent of the FDA.
Correct.
This MAA for DC Vaxxel and glioblastoma is the entire ballgame right now. The MHRA is actively reviewing it, and there is a very specific, speculative, but massive potential upside embedded in this process.
What's that?
Because glioblastoma represents such a dire unmet medical need, the MHRA has a mechanism to grant a rapid 150-day review pathway for new medicines.
Oh, wow. If the MHRA grants that rapid pathway, it dramatically compresses the timeline.
Exactly.
It could potentially accelerate Northwest's path to a first reimbursed commercial launch as early as 2027. That would finally turn the spigot of revenue on and theoretically break them out of this endless raise-as-you-go dilution spiral.
And they are clearly leaving nothing to chance here. On April 30th, 2026, they oath me in Dr. Annalisa Jenkins as a strategic advisor. Her specific mandate is to help them navigate this exact regulatory hurdle and prepare for the commercial reality of launching the drug.
Bringing in someone with deep regulatory expertise is critical right now, because the MHRA is not just reading a stack of clinical trial data.
Right.
They are conducting physical inspections. They are auditing the contract research organizations, digging through the trial master file, and crucially, they are inspecting the GMP good manufacturing practice standards at the Sawston facility.
It always comes back to the F1 factory. The regulators have to be absolutely certain that Northwest can consistently, safely manufacture this bespoke biological therapy in a clean room environment without a single margin of error.
Yep.
But I want to map out the downside here. Let's say the MHRA doesn't reject the application outright. Let's say they just want more clarity. What happens if the regulators say, you know, the data looks promising, but we need 6 more months of manufacturing data from the Sawston plant before we give the final green light? Given that $1.8 million bank account, wouldn't a delay be just as devastating as a denial?
A delay of that magnitude would be financially catastrophic.
Yeah.
In their current state, they do not have the runway to calmly answer regulatory questions for half a year. If the MHRA hits the pause button, Northwest still has to pay the engineers, run the clean rooms, and keep the lights on at Sawston.
Which costs millions.
Exactly. To fund that unexpected 6-month gap, they would be forced to return to the market and issue tens of millions of additional shares.
And because the market would be spooked by the delay, they would have to issue those shares at absolute rock bottom prices.
Right, resulting in unprecedented dilution. The stock price would likely collapse under the sheer weight of that anticipated dilution. They don't just need regulatory approval, they need regulatory approval at an accelerated pace.
Knowing that this MHRA decision is this massive ticking clock, the technicals of the stock show us exactly how the market is placing its bets. And let me tell you, the sentiment is incredibly polarized.
The disconnect between the current trading reality and the potential valuation is striking.
Look at the chart for ticker symbol NWBO. The stock is trapped in a sustained, heavy downtrend. It is currently trading right around 18.5 cents.
Wow.
Yeah, that is barely hovering above its 52-week low of 18 cents, which it hit back in June of 2026.
It has been a very painful year for shareholders. The stock is far below its 52-week high of about 37 cents from the previous August.
Yep.
The multi-week returns paint a bleak picture, down 10% over 13 weeks, down 23% over 26 weeks, and down nearly 25% over the past year.
The chart basically screams distress. But then you look at specialized equity research analysts who are staring at the exact same clinical data and the exact same balance sheet, and they are arriving at a wildly different conclusion.
Like First Berlin Research.
Exactly. They recently initiated a BUY rating on Northwest Biotherapeutics, and they slapped a price target of $1.00 on the stock.
A $1 price target on an 18-cent stock represents a massive 370% upside.
Yeah.
But it's important to understand how they arrived at that number. They are using a sum-of-the-parts valuation model.
Break that down for us. How does some of the parts work in a situation like this?
Well, an analyst using this model doesn't just look at the company as a single monolith. They break the company down into its core assets.
Okay.
First, they calculate the present value of the DCVax-L intellectual property, basically what the drug itself is worth if it gets approved for glioblastoma.
Right.
Then they evaluate the physical infrastructure. They look at the Soston facility, the Grade C clean rooms, the manufacturing capabilities, and assign a value to that physical asset.
Got it.
When you add the value of the drug IP to the value of the manufacturing plant, First Berlin concludes the whole package should be worth $1 per share.
So we have a $1 analytical target colliding with an 18-cent reality. If the analysts think the drug and the factory are worth $1, why is the market pricing it at 18 cents?
That's the big question.
Is the market pricing in a regulatory failure, or is it just pricing in the massive wave of dilution that will inevitably be required to get this drug to the finish line?
I'd say the market is absolutely pricing in the cost of capital and that impending dilution.
Really?
Yeah, institutional investors might fully believe that DCVax-L is a brilliant therapy that will eventually get approved, but they also know Northwest only has $1.8 million in cash.
Right, they can do the math.
Exactly.
Mm-hmm.
They know the company has to issue more shares to survive.
Yeah.
So why would a major buyer step in at 25 cents or 30 cents today when they know the company will be forced to flood the market with cheap shares next month just to make payroll?
They wouldn't.
Right.
Yeah.
The buyers are sitting on the sidelines, letting the stock consolidate at the bottom of its 52-week range, waiting for the dilution to finish before they take a position.
The technical data reveals another fascinating quirk about how this stock trades, actually. The sources note that Northwest Biotherapeutics has a negative beta of negative 0.616.
Ah, yeah. That negative beta is a classic hallmark of a high-risk biotech stock facing a binary catalyst.
How so?
Well, beta measures how a stock moves in relation to the broader market, like the S&P 500. A negative beta means that this stock often moves completely inversely to macroeconomic trends.
Oh, so it is entirely disconnected from inflation reports, interest rates, or, tech earnings.
Completely. If the S&P 500 crashes tomorrow, Northwest Biotherapeutics probably won't care, because the only thing that moves this stock is news about the MHRA application or their cash position.
It trades in its own isolated ecosystem of idiosyncratic risk.
Beautifully put, though there was one piece of positive structural news buried in all of this financial stress.
What was that?
When Northwest acquired Advent Bioservices, that transaction actually triggered the return of 19 million securities that had previously been issued to Advent.
Oh, right.
Those shares reverted back to Northwest.
That is a critical detail because it effectively reduces the float overhang. It takes 19 million shares out of the dilutive pool from prior financing arrangements.
Exactly. In a sea of endless share issuance, shrinking the float even slightly is a rare victory for the remaining shareholders.
It demonstrates that the acquisition of Advent wasn't just about securing the physical building in Sawston. It was also a strategic maneuver to clean up some of the historical capitalization table.
Precisely.
So taking all of this into account, the phenomenal clinical data, the terrifying cash burn, the looming regulatory decision, and the massive upside potential, the sources we are analyzing give Northwest Biotherapeutics a bullish score of 7 out of 10.
But any investor looking at that 7 out of 10 really needs to read the fine print.
Oh, for sure.
This is classified as an extreme high-risk, high-reward scenario. The entire investment thesis is fully contingent on a multi-year time horizon. You are essentially holding your breath for the MHRA approval in 2026 and then waiting for the actual commercial rollout and revenue generation in 2027.
If the MHRA grants that approval and that Sawston facility finally starts pumping out commercial batches of DC Vaxel, that 370% upside to $1 a share could very well become a reality.
They could.
But if there's a delay, a request for more data, or a denial, that $1.8 million bank account means the floor could fall out from under the stock overnight.
It requires an iron stomach for volatility and a deep, deep conviction in the underlying Phase 3 clinical data.
Before we wrap up today's deep dive, I want to leave you with a final, broader thought to mull over. We have spent this entire time analyzing the acute financial pain Northwest Biotherapeutics is enduring simply because they insisted on building their own in-house bespoke manufacturing facility for personalized cell therapy.
Right. It has pushed them to the absolute brink of insolvency.
But what if they actually pull this off?
The implications for the broader pharmaceutical industry would be massive.
Think about it. For a century, the pharmaceutical industry has relied on the Henry Ford model. Make one pill in a massive factory, stamp out 1 billion copies, and ship them worldwide.
The classic blockbuster model.
Exactly. But if Northwest Biotherapeutics proves that a vertically integrated in-house manufacturing model for personalized, bespoke therapies can not only cure aggressive cancers, but also become a profitable business model, what does that mean for the future of medicine?
It changes everything.
Could this F1 factory approach, treating patients one custom batch at a time, become the new blueprint for treating all complex diseases? And if it does, how long until it completely disrupts the traditional mass production pharmaceutical giants?
The era of the blockbuster generic pill might be ending, making way for the era of biological artisans.
It is a truly fascinating space to watch. Thank you for joining us on this deep dive. We'll catch you next time.